Hi, and welcome to One-to-One Mining Investment Online. Today, we're pleased to welcome Guy Keller, Portfolio Manager and Commodities Analyst at Tribeca Investment Partners. Guy will take us through the current market dynamics for uranium, industry misconceptions, and the outlook for nuclear energy as we move forward. So, please welcome Guy.
Thanks for having me. We're here to talk about uranium, and it's, out of all the commodities we look at here at Tribeca, it's by far the most interesting in that you've currently got more than 50% of monthly mine supply offline, triggered by COVID-19 concerns, at a time where the demand really hasn't fallen off because there's still a demand for low carbon baseload electricity generation from nuclear reactors. So with that in mind, Tribeca Investment Partners, we run a number of strategies. Most relevant here is our global natural resources and the micro focus on nuclear energy opportunities. We're going to cover a fair bit of activity throughout the whole sector here today. This is quite relevant just to talk about quickly. Unlike other commodities that are used for power generation, where they can pretty much be burned in the generators to create electricity straight away. Uranium from mine mouth is actually a process of 18 months to 2 years to get it to the point that it can be used for generation. So we do talk a little bit longer term with respect to uranium and nuclear fuel than perhaps other baseload fuels. Fantastic year-to-date performance. As I mentioned before, we already had a very tight fundamental structure that had uranium at the top of our batting order for the last 2 years. And as we've seen here, it's had a very strong year-to-date price performance that's been completely counter-cyclical to everything else going on. And even with the most recent price move in gold, uranium is still outperforming that even. We can see here the price history. The last 5 years in the uranium spot price, we've seen very similar things happen to the last bull markets, where for technical reasons with some flooding and some of Cameco's mines, that supply came offline. This, of course, is slightly different. It's price related and COVID related. However, you can see there's been a bunch of key events here that have converged to this price move. I've been in commodity markets for over 20 years and lived through those three and other commodities where we've seen supply cuts. I think the important thing to note here is with other supply cuts and other commodities, you've seen a very good price response on what is quite a small supply cut. You can see here we've seen a 25% supply cut in uranium, which far outweighs any of the other moves. So it's still our strong belief that there's a lot of upside still to go in the spot price. We have noted over the last few years there's been some handbrakes that have stopped our thesis moving forward, most notably in the US. The US is the largest consumer of uranium and tend to, the utility activity tends to lead the rest of the market in many respects. And we've seen a lot of 232 investigations which moved to a fuel working group, and there's been delays there. But as you can see, those handbrakes have been released, and ironically, COVID has been the spark that has lit the match under a pretty tight market, caused further supply problems. Focusing on supply, because that's really the catalyst for the moves here. You can see here, so this is Cameco and Kazatomprom, the two largest, lowest cost uranium producers in the world, have been forced to take down supply. As a result, Cameco is currently not producing any uranium, and Kazatomprom are down 17% from their 2020 guidance, and that's on top of previous supply cuts that they'd announced in 2017. You can see that we were already seeing a drop in mine supply of uranium over the last few years, and COVID has just created yet another hole in that supply gap. This is a chart of the cumulative supply and maintenance cuts since 2013. It's in order of what's been cut. You can see here that there was a steady progression of a number of projects coming offline as a result of low prices, that then saw some movement at the big end of town. Paladin with Langer Heinrich, Cameco with MacArthur River, and Kazatomprom cut. So this was some of the lowest cost supply coming off. And now as a result of COVID, you've seen Kazatomprom and Cameco cut even further. So it's over 70 million pounds of primary mine supply has come off cumulatively since 2013. And that compares to a demand market of anywhere between sort of 185, 195 million pounds. So it's a large chunk that's come off. We note here in the box on the side that, I mean, Cameco have been very public in stating that they would require a price somewhere in the mid-40s to consider restarting MacArthur River, and that would be with contracting. And Cigar Lake as well. They want commercial terms with respect to contracting as well. We've estimated in our modelling that Cigar Lake will be out for probably 6 months, as they may probably bring forward some of their care and maintenance. You know, Kazatomprom as well, they're not going to ramp up again just to deliver into the spot market or the intra-year market. Kazatomprom will ramp back up again once COVID is cleared, when they have some volume-linked market contracts. So there is the demand for that extra supply, and they'll do that. And Paladin, of course, again, the other big producer, they require somewhere over $45. They're going to have to raise some capital. And of course, all of these projects are going to take time to come back to the market. It's not like they're going to turn on and be with us tomorrow. When we look at the cost curve here, you can see the grey bits here are Cameco and Kazatomprom's previous care and maintenance cuts, and the yellow boxes here are what other suppliers have been affected by by COVID-19. We forecast that our primary mine supply for 2020 will be somewhere around 110 to 115 million pounds, down from last year of about 135 million pounds. And again, remember, that's demand averaging around 190, 195 million pounds. So you've seen a very big deficit that was already in existence. It's just got even bigger. And, you know, reminding again that when we look at this current cost curve of current production, there's going to be some mine closures next year as well, which will bring that supply down even further. So the WNA, as part of their 2019 nuclear fuel report, put out demand and supply projections. They look at 3 different demand scenarios, being lower, reference, and upper scenarios, and you can see those as the lines there. The definition of what is from their report as to what how they define that. You can see here already 2020, we've taken out that chunk of COVID supply loss, which is unanticipated, and probably will also start to impact 2021 estimated supply. But even if we just take the lowest case demand scenario here from the WNA, which as says there, it's an entirely plausible representation of future events, you still need a lot of these other coloured boxes to come to market. So that's not only the idle capacity that needs to restart, it's those mines that are planned, and also as we go further out, it's prospective mines. So, you know, anybody that's been around the mining industry for any period of time, whether it's uranium or another resource, knows that there's a lot of things that can go wrong in not only keeping the current level of supply, but also bringing new supply on. It's not just price. So let's say we get to a $45 or $50 price to incentivize these guys to make a final investment decision. There's a whole bunch of other things that need to happen, and we've just named a few here. They need money. They need to make sure their permitting is okay. They need to be in a jurisdiction that allows and is friendly to uranium mining. You have a good management team to make sure they hit their targets in construction and ramp up. So there's a lot of things that need to go right. And even then you still have, if you assume just their reference scenario, there's a really big gap of supply that needs to be filled here. We focus quickly on demand. This is just, a lot of people talk to this number, 450 reactors in operation, 54 under construction, the planned and proposed. I like to bring that back to pounds of uranium. You can see here, of the operating requires around 200 million pounds of uranium. Construction's about 25 million. So that's the reactors and the construction. If you come across to this chart on the left-hand side, that is putting that 25 million pounds into context. So you can see here, ex-China. So reactors being built outside of China require another Cameco-McArthur River mine to fulfill the demand from those new reactors. The ones being built in China, they require more than one Husab, which is their flagship mine in Namibia, to come to market to supply that. And when you look at, for example, Boss's Honeymoon project here, which is one of our preferred assets to be coming on in this first wave, you know, it barely covers some of these other smaller countries' requirements. So there's a lot of new uranium that needs to come to the market just to fill what's under construction. We haven't even looked at the plan and proposed yet. We hear a lot about the Western utilities. You know, they have been running down their inventories, which is a little bit counterintuitive. Inventories generally should be saved for periods of high prices and scarcity of supply, but due to a bunch of other problems that we've seen over the last 10 years with respect to how they've contracted, it has made more sense for those utilities to unwind those inventories at the bottom of the market. You know, that's bullish. We're seeing here as well the supply contract coverage. The utilities have been running down their contracts because there's been low prices. There's been some availability in the spot market as a result of low prices, excess material getting dumped in there. You know, and all of this is bullish because, as we've seen in the last little bit, that supply has been drying up. China is the big, regardless of what you say about the West, China is the big mover with respect to demand. And you can see here, there's some recent developments over the last 3 years as to, they've brought on, I think, 12 reactors in the last 3 years. And most of these reactors are for China, a new technology. So, you know, they were wanting to make sure they could build them on budget and on time. They could safely connect them to the grid, and that they're going to do what they did, do what they're supposed to do, and to allow them then to now increase that. There's a little bit of blurb on the 5-year plan. I'll let you peruse that at your own discretion. But needless to say, in the current 5-year plan, to reach the upper end of the band, China is still 35 gigawatts short of what they plan to get there. So, assuming they do what they plan, they still need to do another 35 to get to the top end of that 5-year plan. A lot of misconceptions around uranium. Inventory is one of them. You know, I hear it a lot. There's a lot of inventory, and can I tell you, after 20 odd years in physical derivative commodity markets, I've seen a lot of commodity prices rally when there's been a perception of high inventory. And what becomes important is not how much inventory is out there, but how much of that inventory is available to the market. I think Cameco refer to that as mobility of inventory, but it's the same concept here. When you look at the Chinese inventory and when you look at the Japanese inventory, that's not available. It doesn't matter necessarily, in our view, what happens in Japan as to the delays, and we'll touch on that in a slide a little bit later. That inventory is not available to market, nor is China. When we look at European and US, that inventory has been drawing down over the last 3 years, as we saw on a previous slide, and it's getting to levels where they get uncomfortable if they have any less. Cameco will be drawing down inventory because they're not producing anything, and Kazatomprom will also be drawing down heavily on that inventory this year, and they'll be well below the levels that they're comfortable in holding, which could mean that you actually see Kazatomprom at some stage this year, and probably towards the end of the year, coming into the spot market because they want to replenish some of that inventory. So again, you know, whilst it seems like a big number, when you actually break it down, there's not a huge amount actually available to the market if they wanted it. Global electricity demand. This is a W&A report, and there's a bunch of other agencies that do similar reports here. showing the growth in global demand. So you can see it's a 1.5% compound annual growth rate. And you sort of say, well, that doesn't sound like a lot, but it's a very big number. This is global electricity generation, and that's a massive number on that. There's that 1.5%. You can also see that the WNA here assume that nuclear stays at 11% of that mix. Now we know that China is wanting to double their nuclear mix in their electricity. And we know also that Japan, when they restart, also want to increase their mix. So, and when you look also on the right-hand side here, the amount of non-OECD countries share that requires electricity, they are increasingly looking at nuclear as a source of low-carbon baseload electricity. So, these numbers are going to get bigger for uranium. The pushback here, I think, that we get is on the left-hand side. We talk about carbon emissions. Again, worth noting here, nuclear is the lowest source of low carbon or carbon-free even baseload, 24/7, not intermittent renewables, but 24 hours, 7 days a week. It is the lowest form of electricity generation on the baseload. We've got lots of case studies here. Germany here, their electricity supply is now twice as carbon intensive as France because they've moved away from nukes. And their electricity price has gone up. And guess what? When the wind's not blowing and the sun's not shining in Germany, they import cheap nuclear power from France. We look at carbon emissions as well, and you can see, there's some stuff about China. The other side here is, nuclear generation costs a lot of money. The reality here is that most nuclear modelling is done on a reactor life of 40 years. We're seeing reactors now getting out to 60 and sometimes 80 years of operation. So when you then add those extra years, even if you look at 60 years, and wind and solar, a lot of that modelling is done off 25 years. So far, we're seeing that most wind and solar has an effective lifespan of 15 to 20 years. And I think the other thing that you need to factor in is that over the 60-year lifetime of one reactor, you need to replace wind and solar at least 2.5 times. So when you look at that, the capital cost argument that it's too expensive actually comes down a fair amount. USA, another great case study. California moved away from nuclear energy and towards renewables. They already had structural issues in their state before they did this. And since then, the spread of electricity prices versus the rest of the USA has just widened. In other words, it continues to get more expensive for Californians for electricity as a result of a reliance on wind and solar and moving away from low carbon baseload electricity and nuclear. I think the other important thing about, again, lots of case studies about nuclear electricity. Nuclear generation is 20% of the USA's electricity needs, yet it's more than half of their low carbon electricity production. So, it's doing more than carrying its weight with respect to carbon dioxide, reducing the carbon dioxide footprint of the US electricity generation industry. Japan, as we talked about earlier quickly with inventory, there has been delays with Japanese reactors coming back, and that's as a result of upgrades that need to be done to qualify for some anti-terror requirements that have been legislated. And we look at the inventory in Japan, and because of the fact that there's still a desire to switch some of this back on, we see Japan as net zero. There's no uranium coming out of, or uranium fuel coming out of Japan. And there's probably not much going back in either. So it's sort of net neutral. This is an investment team. It's Ben and myself. If we just focus quickly on the uranium equities, Obviously, March 23 was a dark day for global financial markets, and uranium equities were included in that. Our portfolio, just the portfolio mix that we had to the end of April, managed to recover 90% from those lows. And we just did a very basic calculation here on that side, and that's basically how far how far away from each stock's 5-year high are they? We've not looked at dilution for equity raisings. We've not looked at any extra pounds or enterprise value added. It's just a pure, simple, where is the price compared to where the 5-year high? And just our portfolio has still got another 250% to go to catch up to those 5-year highs. And why 5 years? Because that's where the uranium spot price is at a 5-year high. So, anybody that says, oh, I think I've missed this move, it's still our view that there's a lot more to go. And I think it's worth remembering as well that even at $34, there is not one extra pound of uranium that's incentivized to come back to the market at $34. So despite it moving a very good distance from all-time lows of 16 and more recent lows of around $24, $25, it's still not done enough to get to any level that's going to bring any pounds back on. This is just our portfolio mix here. You can see we break it up by jurisdiction as well as some different stages. We have, built a warrant book as a result of our access to global deal flow. Remember that the Nuclear Energy Opportunities Fund piggybacks off our bigger and longer standing Global Natural Resources Fund. So we have a number of relationships globally in the resources space that allows us to get that access to almost anything that's going on in this space at the moment. On the right-hand side, I've included a chart of Uranium Participation Corp, which is the spot proxy, or one of the spot proxies. The majority of our holding is London-listed Yellowcake. However, there's a much better price history here because this one's been around for much longer. And just like Uranium Participation Corp, Yellowcake is trading at a historical discount to NAV. At a very large discount to the net asset value of the pounds that they own. So, I mean, it's an example here that even without the market not really necessarily doing much more, that spot positioning can catch up 25% just to get back to NAV. And it needs to do that if they want to raise more money to go into the market to buy more pounds. So, there's a lot of nuances here in the portfolio where it's not just owning one equity that goes from A to B. You can get a bit of movement here within that. And, just to finish up here, we're resource specialists. So we have a criterion approach that we use across all our resource investments. I think the most important thing with uranium that's a bit of a differential is jurisdiction, permitting, and community. They are, they're important for all resource investments, but I think they're highlighted much more here in that it's not necessarily the most popular resource to mine. So that you need to make sure that you're looking at investments that have these boxes ticked. And with that, I think that'll be me to wrap up. So again, thanks very much for your time. I appreciate the opportunity to speak to you all. Thank you.